Silicon Valley Bank has collapsed, causing mass panic throughout the country and even the entire world. This will not only cause startups to go under, but also affect the overall market and retail investors. Find out how the second largest bank failure occurred and how to keep your funds safe in today's video. So the most important thing to understand when it comes to this bank failure is the timeline of events and how it occurred. So this article does a great job of breaking that down. So we can see that SVB is a specialized bank for tech startups. It provides financing for almost half of US venture-backed technology and healthcare companies. So they had $209 billion in total assets at the end of last year, according to the FDIC. In short, SVB encountered a classic run on the bank. So what exactly happened? Well, to keep things short, we'll summarize it like this. The Fed Reserve, which began raising interest rates at a year ago to tame inflation, moved aggressively, and higher borrowing costs sapped the momentum of tech stocks that had benefited SVB, which we can see here, this big decline in tech stocks at the end of 2021 going into 2022. Don't forget to like, comment, and subscribe, and make sure to watch the end of this video to find out how you can take advantage of this opportunity. These higher interest rates also eroded the value of long-term bonds that SVB and other banks gobbled up during the era of ultra-low, near zero interest rates. So during this time, SVB's 21 billion bond portfolio was yielding an average of 1.79%. The current 10-year treasury yield is about 3.9%. So we can see that when they locked in their yield for bonds, it was 1.8%, but it doubled to almost 4%, more than doubled. So at the same time, the venture capital began drying up, forcing startups to draw down funds held by SVB. So same time, people started investing less in VC because there was a big dip in the tech market overall, and it just was a bear market. People aren't spending as much. So the bank was sitting on a mountain of unrealized losses in bonds just as the pace of customer withdrawals was escalating. So this was a bad thing overall. So then panic took over. On Wednesday, SVB announced it had sold a bunch of securities at a loss, and that it would also sell $2.25 billion in new shares to shore up its balance sheet. This triggered a panic among key venture capital firms, who reportedly advised companies to withdraw their money from the bank. So then on Thursday morning, the bank stock began plummeting, with investors beginning to fear the repeat of the 2007 to 2008 financial crisis. By Friday morning, trading in SVB shares were halted down, and it had abandoned efforts to quickly raise capital or find a buyer. California regulators intervened, shutting down the bank and placing it in receivership under the FDIC. So the contagion fears subside. Despite the initial panic on Wall Street, analysts said SVB's collapse is unlikely to set up a domino effect that gripped the banking industry during the financial crisis. So as we saw, there was a big dip in other finance stocks and banking stocks, but people are saying that this fear is a little bit overhyped and that the system is well capitalized and liquid as it has ever been. The banks that are now in trouble are much too small to be a meaningful threat to the broader system. No later than Monday morning, all insured deposits will have full access to their insured deposits, according to FDIC. They're also going to pay uninsured depositors an advanced dividend. So what comes next? While the broader contagion is unlikely, smaller banks that are disproportionately tied to cash-strapped industries like tech and crypto may be in for a rough ride. Everyone on Wall Street knew that the Fed's rate hiking campaign would eventually break something, and right now is taking down small banks. FDIC typically sells failed bank assets to other banks, using the proceeds to repay depositors whose funds were insured. A buyer still could emerge for SVB, but it's far from guaranteed. So outside of the banking industry, who else had exposure to SVB? Well, you guessed it, Crypto USDC token, the stablecoin, is intended to have a $1 to $1 peg. What do you think happened when people realized 3.3 billion of its reserves are at failed Silicon Valley Bank? You guessed it, it lost peg and it went below $1. So let's see exactly how that happened. They have 3.3 billion of 40 billion stockpile in SVB, so almost 10%. We could see that they traded as low as 92 cents. I think they traded even lower in the 80 cents range. And Coinbase had potentially announced temporarily pausing withdrawals. Binance has announced that they don't have any exposure to them. But I think that this is going to be a rocky ride for crypto and tech stocks because people already don't have much faith in the industry as a whole right now when it comes to crypto and tech stocks. Being in a bear market, people don't want to take on extra risk, including myself. I am positioning myself with a very safe portfolio compared to how I operate in a bull market. Right now, it's just too risky to try to pick out those 1 in 100 stocks or altcoins that are going to blow up, rather than picking one that's probably going to bleed a lot harder than the industry standard like the S&P or Bitcoin. So by contrast, bankrupt crypto lender BlockFi, of course, had 227 million in an account at the failed bank. So BlockFi can't catch a break. People like BlockFi, Celsius, Voyager are giving the whole industry as a whole no trust in exchanges. So I think this is a very, very interesting time to where we can rebalance our portfolio and hopefully take advantage of this rather than panicking like everyone else. So let's get into the meat and potatoes, the most important part of this video: how to protect your funds, what is the bottom line, and is there an investment opportunity on the horizon? Of course, none of this is financial advice, and you should always do your own research before making any investment decisions. So realistically, the average person is not going to see more than $250,000 in cash in their lifetime. So that means up to $250,000 in cash per account is FDIC insured, meaning if a bank went under and you had $249,000 in that bank, you'd get that full $249,000 back. But the crazy part about this is that something like 95% of deposits in SVB were above $250,000. Meaning people had made huge deposits and investments into startups, which makes sense. But a lot of these investments are not going to be, or deposits are not going to be fully insured, which is going to cause a lot of panic. And it's going to probably cause a court case that people are going to be able to try to recover whatever funds are left. So when the FDIC stepped in on Friday, it said that SVB had $209 billion in assets and $175.4 billion in deposits. The rest, obviously, like I said, is going to be settled in court. Startups solely banked with SVB are going to be in trouble. Luckily, most startups didn't solely bank with SVB. They had multiple seed rounds with different investors. But if they did only bank with SVB, they're going to be in big trouble, right? They're going to have a huge issue paying their payroll, expenditures, etc. So what are they going to be able to do? Well, you can already see people on Twitter and founders on Twitter are already apologizing, saying they haven't been able to pay payroll. They're going to have to cut employees. They're going to have to take on new unfavorable loans, or simply they're just going to have to go under. It's really a terrible time for startups and innovation as a whole. And I think a lot of people are worried that this is going to set back innovation in America. And I hope that doesn't happen. And I hope that for everyone involved in this, that they can get their funds back and not be affected, because this is clearly going to affect a lot of people. The safest thing to do is never keep more than $250,000 in cash in more than one account. On top of that, if you bank with the largest institutions like JP Morgan and Bank of America, I don't see you having an issue, as they are very well diversified and don't take on any crazy risk like these smaller banks typically do. How is this going to affect you? I just talked about how it's affecting people with over $250,000 in deposits. How this is affecting you is because there's a whole ripple effect in the market. Currently, the whole finance sector is down. There's 10 to 20% dips in blue chip names like Schwab. The tech and crypto is also affected. So is it a good time to buy the dip? I'm personally looking to buy blue chip names that are down 20% more on the month. And these are just a couple of names that I'm looking at. The triple leveraged NASDAQ, as we can see, the NASDAQ is still 40% off highs. So I think the NASDAQ has a big rally in store for it if we can hold these lows and not break down. I think Monday is going to be a very, very interesting day for the market, so definitely keep an eye on that. We have Schwab taking a big dip as well. Bitcoin, Ethereum also seeing the ripple effect of USDC's little crash and depeg. I think this is going to be a long and rocky road back to all-time highs. I think we had this big run-up that I was talking about, and you heard me warn about, hey, this is a big run-up in the early parts of this year. We're likely to see a dip just based off technicals alone. And fundamentally, I feel like everything was based off predictions later in the year. People thinking the Fed was going to ease, people thinking inflation was going to get better, but really nothing fundamentally has happened. And I kept telling everyone around me, we're one black swan event away from something like this happening. And what happened? A black swan event happened. So definitely keep your funds safe and have a strategy. That's the most important thing, is tell yourself, I'm going to dollar cost average $100 into the S&P every Monday, or I'm going to rebalance my portfolio this weekend, or I'm going to make sure I can generate as much cash as possible by going out and hustling this weekend, going to garage sales, doing whatever you can to generate more cash in the bear market is going to be the best thing you can do right now. And also keep your funds safe by never having more than $250,000 in one account. I hope you guys enjoyed this video and you guys were able to learn something. Like, comment, and subscribe for more. I'll catch you guys in the next one. Thanks.